precious metals are less challenging psychologically than uranium was. When people look at precious metals and they get bored by it, people looked at uranium and they hated it. I would talk about uranium from the podium, and people would come up to me after a public speaking engagement and tell me I was a despicable human being, that I was speculating on Hiroshima, Nagasaki, Fukushima, and 3 Mile Island. At least in the gold and silver business, I draw yawns as opposed to hostility. I think one thing that happens to people around the precious metal sector is when they buy into the narrative, they overbuy, which is to say a little bit goes a long way in precious metals. Precious metals can go very long periods of time, 6 or 7 years, and make you no money. But when they do make you money, they make you gobs of money, and they make you that money quickly. So you need to be in place at the beginning of a market, and you need to have a fairly broad range of tolerance for time. You and I have talked for years about the Barron's Gold Mining Index, which I will send to those listeners of yours who are interested. And looking at that index is really instructive. The average precious metals bull market is not like some people think, 2 or 3 years. The average is 10 or 11 years. And those bull markets are punctuated by fairly long and fairly deep market declines, which is to say cyclical declines in secular bull markets. In 1975, as an example, there was a 50% decline that lasted 14 months. People who got shaken out missed a move at the end of that market from $100 an ounce to $850 an ounce. And they missed a move in the equity indexes that was almost double that. So I think it's important that people understand that these markets take time, and that these markets, the volatility in these markets, will test you. I think, too, that people need to examine their premise around precious metals. I believe that a move higher in precious metals is absolutely inevitable. And I believe that to be true for 4 reasons, which I'd like to give your listeners. Precious metals move higher when people are concerned about the maintenance of their purchasing power, their standard of living, in conventional savings instruments. And I'm going to use the U.S. 10-year Treasury, the largest and most liquid security in the world, to represent the range of savings and investment alternatives around Americans. So let's talk about the reasons why I believe that gold and silver has to go up. Is this fear justified? The first fear, which you and I have talked about before, Dunnigan, is quantitative easing. If you did it, if you printed something called a Dunnigan, you would be accused of counterfeiting and you would be thrown in jail. When Congress does it, it's policy, and they become highly popular, and it gets them reelected. But however you view quantitative easing, what it is the creation of new specious currency units that are introduced to float the economy rather than to accommodate the economy. Some observers suggest that the float of U.S. dollars has increased by 40% over 2 years, which is to say 40% of all the dollars in circulation have come into existence in the last 2 years. So clearly, government-sponsored counterfeiting is taking place on a very, very, very broad scale. And if nothing else gives you pause about the efficacy of the currency, the fact that they're printing lots and lots and lots of it for free means that you need to be concerned. Will it catch up with the dollar? Almost certainly. If you create new ones, if you create new supply without creating economic value, certainly you depreciate the value of existing ones. But the story gets worse, Dunnigan. Beyond quantitative easing, there's, of course, debt and deficits, which you and I have talked about in the past, too. Collectively, in the United States, we owe each other $29 trillion on balance sheet. Now, net of the Fed's own balance sheet, that's only $22 trillion. But that's on balance sheet. We also have off-balance sheet liabilities, Social Security, Medicare, all those things. I'm not going to get into a policy discussion. All I want to say is that the off-balance sheet liabilities, net present value, are $120 trillion plus. And we propose to service this debt with a budget that's in deficit this year, probably $4 trillion. There's a little poem that I'd like your listeners to remember. When your outgo exceeds your income, your upkeep becomes your downfall. And people need to understand that servicing $150 trillion in debt, where your aggregate household income is more than $4 trillion a year, is a challenge. And so people look at this and they become concerned about the efficacy of their savings too. But it gets worse. The worst is negative real interest rates. Negative real interest rates are not a force of nature. If they were, Dunnigan, you would happily save, forego consumption, and lend money to me and pay me to consume now and take on the credit risk. This is totally insane. But the arithmetic around the world's primary savings and investment instrument, which is the U.S. 10-year Treasury, documents this. The U.S. government will borrow your money for 10 years and they will pay you 1.5%, 150 basis points, in a currency that they, not some fat old bald libertarian crank named Rick Rule, they, the Congressional Budget Office, suggests is depreciating by 6.5% a year. So the U.S. government, for the first time in my life, is making a promise which they absolutely will keep. If you give them money today, they will give you back much less in 10 years. Jim Grant calls this return-free risk. Think about the arithmetic of getting paid 1.5% a year and losing 6.5% a year in purchasing power. Think about a 5% negative internal rate of return for 10 years, what that does to your savings. This is why people will become increasingly concerned about the efficacy of conventional savings products, and some will go to gold. Importantly, Dunnigan, the fourth point is that not very much has to go to gold. You hear about the silver squeeze, the gold squeeze. The one that's coming up, I think, will take people's heads off. And here's why. Precious metals and precious metals related assets comprise less than 0.5% of the total value of savings and investment assets in the United States. 0.5%. The 3-decade mean in the United States is 1.5%. So if quantitative easing, debt and deficits, and negative real interest rates cause investor behavior not to accelerate, but merely to return to mean, 3-decade mean, demand for precious metals and precious metals related securities triples in the largest savings and investment market in the world. That's what I think is going to happen. Recent estimates suggest that the retail silver squeeze, the sort of Reddit squeeze, tightened up supplies in the United States overall by 2.5 or 3%. It was a lot of money because the supplies are large. But when you really want to see a silver squeeze, when demand for physical precious metals and precious metals related securities triples, in other words, when they revert to mean, that's when you'll see the silver squeeze. That's when you'll see the gold squeeze. Investors and people who are buying precious metals to protect themselves probably want to lean towards gold because traditionally that has been the conservative asset class for asset protection. Speculators, I think, need to look to silver, Dunnigan. I'm not saying that people should speculate or invest, but what happens traditionally is that in the second half of a gold bull market, when market leadership is established by gold and momentum is established by gold, silver begins to outperform gold and outperform substantially. So investors should look to gold, speculators should look to silver, and aggressive speculators probably should look to silver equities. Traditionally, the highest risk, highest return, most volatile asset class in the whole precious metals space are silver equities, simply because the combined market capitalization of all the silver equities in the world, or at least all the high quality ones, is so small that when the generalist investor adopts the narrative and tries to crowd his or her money in that space, there just isn't enough capacity in the space. I think that people who don't have a position in precious metals equities currently are making a mistake. I think you need to establish a position. The price of the mid-cap gold companies, as an example, the sort of $2 to $5 billion gold companies, gold and silver companies, is as cheap relative to the free cash flow that they generate at today's commodity prices as they have ever been. So establishing a position, perhaps it's a 50% position, perhaps it's a 60% position now, but keeping cash available to take advantage of market volatility, if the investor has sufficient resources available to him or her to do that, is well advised. I'm adding to my precious metals equities positions now. But I also am cognizant of the fact that during market perturbations, all classes of stock, including precious metal stocks, get cheaper. Maybe not cheaper for a long time, but get cheaper. So I have an opportunistic bucket of cash set aside in order to take advantage of those opportunities should they arrive. Nobody that I know is smart enough to call tops and bottoms. Bernard Baruch famously said that the only investor who ever called the absolute bottom an absolute top was a liar, that it didn't happen. And so I would advise your questioner to establish a position, probably a high-quality position now, and keep some cash set aside to take more speculative positions should perturbations, should volatility occur in the market.